Mr. Wong, you love to identify opportunities in the marketplace. And today, you've identified a new one. Previously, it was revolutionizing the way that people in Hong Kong were calling internationally. And today, it's going to be the way that they're receiving entertainment and the way that they're watching free TV. In doing so, you're looking to provide what the people of Hong Kong really want, and that is access to quality content and free access to this quality content. So let's take a look at what you're up against, because currently this market is dominated by a monopoly player. That monopoly player is TVB, and they're going to be your largest competition. This industry looks the way it does because of government regulation. Government regulation has restricted licensing and has consequently led to decreased quality and a stifling of the talent. As a whole, this is degrading the industry. But what it does do is it gives you an opportunity as a market entrant. It gives you an opportunity to come in and give what the people want. So let's take a look at what the industry can actually look like in the future. We believe that in 5 years, this is what the industry will look like. The entire landscape will change as you enter into the industry. And this is given an assumption that you are going to be able to achieve your 10-point rating. Now let's take that further than an assumption. Let's show you how to get there. We've come forth with 3 main objectives today. And those are, firstly, is creating that quality content. The content that you're going to build the cornerstone of your company off of. Secondly, gaining the views necessary to actually, thirdly, monetize those views and remain a competitor in the market. We've identified 3 main strategies. Firstly is introducing equity options for your talent. Jason's going to talk to you today about actually getting this talent on board and having them adopt your vision and your mission. Secondly, we're going to introduce Enzo and Sean, and they're going to come in and talk to you about how you can launch your content immediately. Why? Because this license is impending, and you don't know the actual date that you will be able to enter into the TV market, we're going to show you a way to get around that. And then thirdly, is to tailor your advertising through interactivity. And this is an area that you've already expressed interest in with second screen social TV. Together, these 3 objectives are going to allow you to enter into the market with the best fighting chance. And when you enter the market, you will be able to take down the monopoly. I'm going to bring forth some requirements for our objectives today. So firstly, in order to actually create this quality content, you're going to need to ensure that you have the talent buy-in, that you have the appropriate talent and the infrastructure necessary to create a quality production. This quality production is going to be a key differentiator for you. Looking more into differentiation, we have 2 requirements for your second objective, and that is to differentiate your offerings for the viewers and then offer them in appropriate accessible channels. And then lastly, to actually monetize those views. The area that I will be covering is how you can best sell your limited advertising space and how you can fully leverage social TV to the best of your advantage. Now, Jason's going to begin by discussing our first objective.
Producing high-quality content is the heart of your business and your ultimate objective. Without high-quality content that is in high demand for consumers, your business will not succeed. However, creating creative content can be very difficult, but the rewards are substantial. In fact, we believe that the value of producing a successful TV series is in the range of $125 million net present value against an investment cost of around $30 million, a very attractive investment opportunity. However, the problem is not all productions will be hits. In fact, in America, only 1/3 to 1/6 of all produced TV series will actually make it to the television screen. This means that there's a lot of money that is invested in shows that will never reach the screen and is ultimately wasted. Your competitor, Television B, they focus on producing as many shows as possible and hoping that one of them will catch. And this is a model that is copied by many companies in America. We believe that your company can take advantage of this. The degradation of content in Hong Kong will allow you to target producing fewer but higher quality content and reducing the amount of misses or flops to generate more hits. And this, in fact, can be quantified in net present value savings of around $1.5 billion over 50 production series. So now that we've talked about why hits are important and why flops will impact the economics of your business, let's talk about how you can actually produce a successful hit. you need to have the best equipment. And this is something that your company has already begun doing. You've invested in a multimedia facility. You've purchased the highest quality cameras. Additionally, you need to attract and retain the top talent. You've been doing this by selling them the message that you will give them a work environment that is autonomous and gives them a creative license. And lastly, you need to provide compelling incentives for your talent to produce hit television series. We feel this is an area where the industry has been lacking. Currently, you pay talent in a salary or a wage base, and there isn't much ability to participate in the actual upside from generating a hit. We believe that by providing equity options, you'll give your employees, or you'll give your talent the ability to participate in the growth of your business as you steal market share from TVP. So what might this look like? We're suggesting that you issue 39 million options at a strike price of about $1.75, vesting over a period of 3 to 5 years. The first concern might be that dilution will dilute your controlling interest over the business. However, you do not need to be worried. This is a dilution of only 5% of the shares. And additionally, you could explore options such as issuing a second class, a class B, if you will, of non-voting shares to further make sure that you maintain your control. And to the talent, the upside is quite large. Since you're distributing these options over only 170 talent, the upside to the individual basis is very compelling and will provide them the incentives to try to deliver more hits in order to grow your business and allow you to participate in that upside. So we've identified some key ingredients to creating an environment where hits can be generated. And now Sean will talk to you about how you can distribute that high quality content once you've generated it.
Before you pass it on, I'd like to ask a question.
Sure.
Can you elaborate a little bit more on how you're going to prevent flops? I thought I heard you say you prevent flops by hiring talent, by having good equipment. Well, Hollywood has top quality equipment, they have arguably a lot of talent, and yet most TV shows produced do not make money.
Definitely.
According to the model, and at least in the US, that you're advocating. So why would that work in Hong Kong?
Definitely. We believe that you will be able to achieve a higher rate. And this is because the environment is different in Hong Kong. As you mentioned, Hollywood is very established, there's a ton of investment, and it's less of a monopoly as it is here. Because you're going against a competitor, TVP, who is focusing on just trying to produce as many shows as possible, hasn't faced very stiff competition, we believe that there is an opportunity to produce successful, higher quality content because the competition is less stiff. And we think that is definitely something you can achieve with the right incentives, the right talent, and the right equipment.
In the very beginning of the presentation, you assume that the company in 5 years will only be able to attain 10% of the viewership. Why is it so conservative, or you may say it is too optimistic? But what's the basis for this 10%?
It's a 10-point rating, which is actually more than 30% of the market. So that's just important to note. And we want to be conservative because you're looking to change the Hong Kong television market, but you're still limited by the fact you haven't been issued a license yet. We're not sure when within the next 5 years you're actually going to get that license. So in order to remain conservative, we don't want to project too much growth in that short period of time, considering you haven't actually gotten your license yet and haven't been able to start disrupting that market.
Not to be disruptive, this compensation incentive scheme, which is stock option, which actually is a thing that's people are moving away from. Now, let's assume this is an acceptable scheme, whether dilution or whatever, to control the shareholders. So today, I'm TDB. Why couldn't I not initiate something similar, and what's prevent them from doing that?
Right, definitely. TVB could introduce a similar compensation package, but we feel it's more attractive at your company. Because Citi Telecom is trying to build a new business. They're trying to steal market share from TVB. They're creating a new entity. We think that's a much more compelling valuation, or a much more compelling offering than TVB, who would be offering you equity in a company that has maintained market share, there's less room for growth, whereas with your business, you're actually building the business. So you encourage talent to come over with that vision of building the business, and now you're giving them the ability to benefit. And if you can actually grow that market share, as we were mentioning earlier, to 33%, the equity upside is extremely substantial. Television B has a market capitalization many times greater than your own currently. And by letting your employees benefit in that upside, we think that's a very powerful motivational tool.